We're joined now by Shaun Latter, Managing Director of Quaestor Wealth. Shaun, thanks very much for your time. Well, we've got to put the same question to you. You've got 1 year, you could choose any currency. There you saw Arno hedging his bets. He said gold, he said the euro and the rand over a 1 year time frame. Are you backing the man?
Yeah, I think that maybe to take a step back, firstly, gold is not for me. I'm going to have to take it out the basket. And maybe just to be interesting, firm South African favourites. I'll just go for the rand and put it all in there and see what happens.
With the rand. 2012, when it comes to financial planning, there's uncertainty out there. That's the only thing that we can actually be certain about. And the other element that's creeping in is this low yield environment, and that investors are going to have to re-look at expectations. And that's the reality going forward.
Absolutely, Bronwyn. And I think there's no mistaking it. We've come out of a few years of manic markets, and investment portfolios in some regards are left worse for it. So, to me, the sense and the trend that I'm seeing in many clients these days, it's a matter of sort of coming to the table and saying, let's rebuild, let's take stock, let's see what we've got, let's see how we can actually plot this forward. And it becomes an interesting exercise, but I think a good one.
Is there panic out there?
I don't think there's panic, not as much as I saw sort of halfway through last year. I think a lot of people are starting to, and maybe it's just an aspect of a new year, but they're sitting down and saying, well, last year was last year, 2011 we're glad to get rid of, and let's start 2012 on the front foot. And let's try and get our affairs in order. Let's start trying to make sense of it all.
In your book, is it about diversification? Recently speaking to Glenn Silverman, CIO of Investment Solutions, he was clearly of the opinion that diversification across a number of different asset classes, including gold, which you've said is not for you, is key.
Absolutely. I mean, if you look at it, the average investor out there is not looking to try and beat the market, and they're not looking for pure market returns. Many people are trying to just get a return that's suitable for whatever their required lifestyles are. So I think on the back of that, most clients need to set a return objective for themselves. And we know from experience that the most reliable way of setting those return objectives is to get the right asset allocation in place. And that's part of diversification, yeah.
So, I mean, listening to Glenn and to Arno, all the bears, what's the correct asset allocation? What's your asset allocation?
The asset allocation, again, and not to kind of dodge the question, is going to come down to the return target. And if we have a look at, I would say, majority of the clients, they are not in a position of being able to take on a return target of less than, let's say, inflation plus 2.
So it's capital preservation.
Capital preservation has got to be
6 plus 2 is 8.
You're looking at 8.
So you've got to get 8 after tax.
You've got to get 8 after tax as a minimum. Outside of that, one has to start
so 8 after
racking it up.
tax means you've got to get like 12.
Does this feature
assuming that your clients have got money, 40% tax rate, 12% after tax.
Or maybe that growth, part of it's coming from capital growth and part of it will be coming from dividends as well.
We're talking to bears that don't look for growth. They're looking for decline.
We're looking at a declining environment, very, very low yield going forward.
I think this is the interesting thing as well, is when one sits down with a client and you start not looking at the next year and you start looking at the next 20 years and you understand the impact of supposedly avoiding risk and being conservative, one sees the effects of inflation and one starts seeing how risky it is not to take on at least some of the market for the benefit of the long term.
I'm just battling with it, and I think if we go through this very briefly, if you look at bonds and individuals whom I assume are your clients will pay full tax on interest received on the bond market.
Sure.
The long end, maybe 8%. So you're paying tax on 8%. That means it reduces it down to about 4.8% or just under 5%. You've got preference shares which are giving 6.5 to 7%, which gives a net yield. So it's very difficult to reach the kind of targets. Property trusts, also you're taxed on the income that you receive there, which is 7 or 8%, maybe 9% if you like. You're taxed on it. So it's very difficult to get to your target.
Without taking on the market.
Without taking on the market or hoping
Yeah.
that we're going to get some kind of British American tobacco which grew at 50% last year. You know, we've got to find those winners.
Yeah, that's the absolute truth. And when one looks at the market aspect, in other words, how much one then goes and puts in shares and stocks, you have to be very careful and try and find those pockets of value to
Do you
try
believe
and
that those pockets of value still exist?
Yeah, I do. I think this is going to be. I don't share Arno or Glenn's. I know Glenn well, and I think, you know, I won't say I've discussed this with him many times, and I still think this is going to be a very good year for commodity shares. I think that's where we're going to make our gains this year.
But you have long been an advocate of commodity
We
stocks.
did well last year. You know, ignoring Billiton and Anglos. You know, if you take your Exaros, your Kumbas and Sassels, you did okay. We're already doing well, and I see it coming through. You know, over time we've done very well, and I think continuing with some of last year's favourites.
Shaun, let's get your thoughts on sectoral bias here. Do you think that being overweight resource stocks is a good position to hold? Obviously, it depends. I mean, I know it's very complicated from your perspective because you've got to look at the risk profile of the individual, et cetera, et cetera.
Yep.
But let's say in your book.
In my book, to tell you the honest truth, I'm actually putting that role straight onto the asset manager. It's not my area of expertise, and it's not something that I can realistically try and take control over. I think
so who do you back in the asset management space then? What kind of...
Not me.
That's why he's giving you a hard time tonight. You've got to start backing. What are you looking for?
There's two areas that I'm going to look at. Okay, number one is if I'm going to go with an active manager, I want an active manager that's going to go deep value, okay, and at times perhaps contrarian, and not be cognizant of any benchmark or index or whatever the case may be. And
so you're a brave man. You are a brave man.
That would be on a minority of one's portfolio. For the rest, and especially going into the low yield environment going into the future, one has to look at costs. And we're starting to see passive and indexation solutions coming into the market that are more and more sophisticated and making more and more sense for the average investor out there.
You see, that's what's going to put you out of business. Passive indexation.
I don't understand what they do, so I can't even.
I
can't even argue with Shaun.
They track the indices.
But last year the index went zero.
That's correct.
So I mean, and
how many active managers outperformed?
I know a lot of us did well, really, and that's not through a selection of shares. You know, generally you could have made anywhere from 10 to 20%.
But then let's look at the cost element that Shaun puts on the table, because cost
That's why I disagree with the
yield
indices, because you spread too wide. You've got to find those stocks that are going to win.
But you've really got to shoot the lights out to justify the costs that active managers are charging, don't you?
Oh no, well those are the coronation. Those are the ones that Arno, you know, who started charging.
Money. You see, it's a square go. Put money with David Shapiro. His costs are low. His performance is excellent.
We just give advice here. You don't even have to pay any costs. You can hear it for free here.
Bronwyn, in the active space, I agree with David. If you're going to have a portfolio that's actively managed, it's got to be concentrated and it's got to be high conviction. The problem is most investors out there don't have access to that private treatment, and most of them have to go the unit trust route. And once you start going the unit trust route, that's when it starts to become very blurry, especially when one looks at costs. So I think that's the first thing to look at. The other side of it is that in this low interest rate environment or low growth environment, an aspect that David picked up on was tax. And that's something that we look at very, very closely, is to make sure that we're not giving anything away to the tax man unnecessarily. And when you start looking at all the tax rates and whatever, you must understand that most people's portfolios will have an element of retirement funds, in which case tax is off the table. We don't have to worry about it. You know, when we do have discretionary investments where tax is an issue, one has to balance it off in terms of what are the exemptions that you can actually get. So by and large, we try and avoid the tax
We've got to wrap.
burden.
You want to make one final
The
statement?
only thing is that you're not taxed now, but when you start to get your annuity, you're taxed.
For another day. For another day.